Okay, so we did question number 1. Let's start with question number 2. Expected return CAPM. It's a March 2003 question. Your client is holding following securities. Particulars of securities: equity share, gold, silver, bronze and GOI bonds. The cost of those securities is given. Dividend and interest is given, market price is given, and beta is given. It says that average return of the portfolio is 15.7%. Calculate, number 1, risk-free rate of return, and number 2, expected rate of return of each security using CAPM model. How will we solve for this? Correct. Yes. See, एक मिनट फैन शुरू करते हैं. Yes. See, what we have here is we have different cost, dividend and interest received on these securities. Then we have market price, and then we have beta of the securities. What we get to know is that average return of the portfolio is given as 15.7%. Number 1, calculate risk-free rate of return, and second, calculate expected rate of return of each security using CAPM model. Now what we will first do is we will calculate, number 1, actual return on each of the stock, isn't it? How can we calculate actual return? See, you purchase a stock for 10,000 rupees, then it became 1725, and then by the end of the year it became 1900. So actual return of the stock will be how much? That you have a capital appreciation loss of 200 and dividend of 17. That means core return is 1525, and 1525 as a ratio to 10,000. So in this fashion we will calculate returns of each of the security. So the return that you would get to earn on Government of India bonds, that 3600, dividend became, cost was 3600, then you got dividend of 3600 and market price reduced further. So based on this, can you calculate or get an intuition as to what would be the risk-free rate of return? If you have Government of India bonds which you purchase for 3600 rupees, now they give you interest of 3600, right? So that means that you've received coupon of about 10%, and then market price reduced further by 1500. So that means your net income is 3600 minus 1500, and that as a ratio to 36,000. So the return earned on Government of India bonds, isn't that the risk-free rate of return? Yes. So we can get the returns on the entire market by using an average. Then we can get the returns on Government of India bonds, which will give us an RFR, and using that then we can calculate expected return on each of the security using CAPM. See, a price of bond can and will always reduce. Why will a price of bond reduce? Have you done bond valuations? That if a bond gives a coupon of 10%, but then the yield in the market becomes 7% or 8%, then the price of that bond in the market will change, isn't it? So then the question is that what is the risk-free rate of return? Is it the coupon rate or is it the market yield? It's always the market yield. So here, the fact that bond prices changed, that means in the market itself RFR has changed, RFR decreased. So when you take both of these into consideration, that will automatically give you risk-free rate of return. Clear? So let's solve for this. So you can make a table like this. Let me also make it along with you. In the same fashion, we can first redraw the same 4 columns. We will say scrip, then cost, dividend interest, market price. Okay, so here I will say scrip oblique security, then the cost at which we purchased it, dividend oblique interest received. So scrip, cost, dividend oblique interest received. Then what we would get is market price here, returns on, and then in this column we will say beta weights and weighted beta. Will you have sufficient number of columns, or should we split this into 2? So do it up to this, then make a separate table for these 3 items. So here you would have to say then scrip or security, then beta, and then weighted beta. Okay, so let's start. First we will calculate for gold limited, silver limited, then bronze limited, and then GOI bonds. 10,000, 15,000, 14,000. Market prices, returns earned is equal to closing price minus opening price plus dividend received, the whole number as a ratio to opening price. Are you done writing this? And below this simply write down a sentence. So we've done with the part A of the question. Say that since the yield earned on Government of India bonds, is 5.83%, the risk-free rate to be used in capital asset pricing model, CAPM, can be 5.83%. Okay with this? Then the second part, expected return of each security using CAPM model. So now, first thing that we will have to do is, before we actually start with this, the average return of the portfolio is given as 15.7%. Let's first calculate. So in part B, you can first say beta of the portfolio. Okay, so again we will write down the 4 scripts. Then we will write down the respective betas, which is given 0.6, 0.8, 0.6 and 1. Then we will write down their market prices here. So have you already mailed the column? Okay. So here we will calculate their weights. See, how do we calculate weights? We will first take total of market prices. Okay, so this is 9800, 16200, 20,000 and 34,500. The value of entire portfolio is 80,500. So what is the weight? Weight is 9800 is invested in gold as a ratio to 80,500. That weight would be 12.71%. Are you following how it is calculated? Amount invested in that security as a ratio to total value of the portfolio. So 9800 as a ratio to 80,500, 12.174%. In the same fashion, I am calculating the remaining ones. And total of all the weights should be 100%. If it is, then your calculation is correct. So once you have beta here, let's call this as A. Once you have weight of that beta, let's call this as B. So you can calculate a weighted beta, which would be A multiplied with B. Here. So beta of 0.6 multiplied with 12%, and then just expand it and take a total. The beta of the portfolio would be 0.812. Are we done with beta of the portfolio? Then in the next step, write down calculation of. Are you done with this table? Should we move on? So in the कहाँ तक पहुंचे हो कुलभूषण? हो गया? So in the next step you would write down calculation of returns on market portfolio. So now see, what is your CAPM equation? CAPM equation is return on portfolio P is equal to risk-free rate of return plus return on market minus risk-free rate of return multiplied with beta of the portfolio. Now what we have is, we have return on the portfolio, we have risk-free rate of return, we have beta of the portfolio. What we need to calculate is what is the return on the market, isn't it, by doing reverse calculation. So what is the return on the portfolio given in the question? The question says that return on the portfolio, average return on the portfolio is 15.7%. So this is given as 15.7% is equal to, we've already calculated RFR, it is 5.833%. So let's say 5.83% plus, let's call this as RM minus 5.83%, and let's multiply it with the beta of entire portfolio, which is 0.81. So 0.81 here. And let's start solving for the equation. So 15.7 minus 5.83, how much would that be? 15.7 minus 5.83. How much? So 9.87 is equal to 0.81 RM minus is equal to 5.83 into 0.81, 4.47 or 48, 4.48, 9 point, so is equal to 9.87. So this number plus 9.87, 14.35 is equal to 0.81 RM, and therefore return on market is equal to 17.71 or 72%. Are we done? And once you've calculated return on the market, you're done with this? So once you've calculated return on the market, then we will do the last step of this question. So you will say calculation of expected return. See, the question says here, calculate expected return for each of the security using CAPM. So we will say calculation of expected returns on individual security. calculation of expected return on individual security here. So again you can make a column. You will say security, then you will say market risk premium, then you will say beta value, and then say expected return. And in the expected return section, simply write down the formula RFR plus beta multiplied with market risk premium. So let's plot those four security. Market risk premium. Market risk premium would be return on market, which we calculated to be how much? 17.72 minus 5.83, and the market risk premium of course remains same, so we just plot it here. Then individual betas, just plot them here, and then calculate expected return, which would be equal to this number plus RFR of 5.83. Market risk premium, this is simply return on market 17.72 minus risk-free rate of return 5.83. So we can write down the expansion here. We can say returns on the market minus risk-free return. Are you done? Should we move on to next question? Is it difficult, easy? It's easy. You should just be able to figure out that what to do when. So first calculate RFR, then calculate portfolio beta, then after having calculated portfolio beta, reverse solve and find out return on market, and once you have return on market, then use CAPM and calculate expected return of each of the security. Okay? Are we good to move now? Question number 3. So this question on this segment I feel is the most likely to be tested, a very popular area for the exams, which is evaluation of security. See this. Following is the data regarding 6 security, returns and standard deviation, returns and standard deviation. Which securities will be selected? Is the question number 1. Assuming perfect correlation, whether it is preferable to invest 75% in security A and 25% in security C. Okay. So this is the question here. Now, which securities to be selected? So there are 2 ways of approaching this, and I would recommend on the exam you should do both. Okay. So how? Logically, Let's start eliminating the security here. See, both A and B have same returns, but B has got higher standard deviation, so we can easily eliminate B here. In fact, even F has got same return, but even F has got higher standard deviation, so we can also eliminate F based on the standard deviations. And the one that we've selected here, let us say, is this one. So let's give it a green mark. Then this security has got return of 4, but the risk is also 4, but by taking risk of 4 I can earn a return of 8. So again, this security can simply be eliminated, so we have a green mark here. Now here we have a risk of 5 for which we are earning 9, and here we have a risk of 12 for which we are earning 12. We cannot compare, and therefore that out of all the investment horizon, the possible security that might be considered for investment is A, then security C, and security E. Are we clear? So this is the approach which is followed in the your practice manual and in the module as well. Okay. But then there is one more improvised version of approaching this. Okay, that improvised version is that we can calculate a statistical number which we learned earlier, which is coefficient of R square was the coefficient of determination. This is coefficient of variation. And coefficient of variation, how do we calculate? Standard deviation divided by mean. That you want to say that how much risk is taken per unit of return. So we can say standard deviation divided by mean, and based on the coefficient of variation we can give ranking to the portfolio. शार्प रेशियो इसलिए नहीं यूज कर सकते क्योंकि आपके पास एक डेटा नहीं है. क्या नहीं है आपके पास? What do you not have here? Risk-free rate of return. Since you do not have RFR, Sharpe ratio cannot be used. Okay? So let's start solving for it. Say question number 3. Now first what you do is give ranking to the portfolio. Okay. So I'll also do it for you here. We will first make the same column. So we'll say security. Then below that we will say risk. And then we will say coefficient of variation. Coefficient of variation. And later on, ranking based on coefficient of variation. Let's go and plot security. See all the securities here now. So A, B, C, D, F, G. कहाँ तक है? F तक है. A, B, C, D, E, F. These are my securities. We missed on returns. So returns here 8, 12, 4, 9 and 8. Risk 4, 5, 12, 4, 5, 6. 4, 5, 6. Then coefficient of variation. In the bracket you can expand the formula here. You can say standard deviation of a security divided by mean return. So here standard deviation 4 divided by mean 0.5, 0.6, 1, 0.6 and 0.8. Then say ranking based on the coefficient of variation. So the one which is lowest will get the highest ranking. So here we will give ranking of 1. Then there is a tie between B and C. So therefore we will give ranking of 2 and ranking of 2. Then ranking of 3 would be given to F. Ranking of 4 and ranking of 4 would be given to C and D. So lower the coefficient of variation, better it is. Now, logically speaking, if I have to invest only in one security, then that security should be which one? Security A, because it gives me the best possible ranking in terms of the lowest possible coefficient of variation. In no case I will invest into security B. And if I'm not willing to invest at a rank of 0.6, ideally all other securities should be discarded by that logic, isn't it? Are you following what I'm saying? See, A is the best possible security for us, and the reason why we choose A because it gives us lowest coefficient of variation. Now we will not choose B because it gives you the same return but a higher risk, and therefore B goes out of picture. So if B is thrown out of picture, which has got a ratio of 0.6, then by that logic even E should be thrown out of picture and even F should be thrown out of picture. Okay. But for your exams we wouldn't write in that fashion. So once you do ranking, then just stop it here. Okay, don't do anything after that. Then what you do is then use this logic that we used. So write down below that answer to part A. In part A, you can have a sub numbering, say section 1 of it, where you'll say that security A, B and F, security A, B and F, all three of them have expected return of 8%. All three of them have expected return of 8%. But the risk of security B and security F is higher compared to security A. Risk of security B and security F is higher compared to security A. And therefore, security B and F should be eliminated from investment horizon. And therefore, security B and security F should be eliminated from investment horizon. Then subpart 2 of this question.
For B and E, we have taken as both 0.6 coefficient of variation.
B and E.
Won't that be different because the risks are different, 5, 8 and 9, so as looks on the rounded off. Yeah.
This is 2. This should have been third. We actually should have seen 2 decimals, you're right. And this will become 4, and these will become 5. Just 0.50 is the lowest, then second lowest is 0.556, third lowest is 0.625, then 0.75, and then 1 and 1. You're right. Yes. Are we good to move? So with this, okay, so write down after this point B. Which ones we have eliminated now? We have eliminated B and F. Now say that risk of security A and security D, risk of security A and security D is exactly same. In bracket you can say 4%. In bracket you can say 4%. Risk of security B and security D is 4%. But Did I say B? Security A and D, yes. But the return of security D is substantially lower than security A. Return of security D is substantially lower than security A. And therefore, security D should be excluded. Security D should be excluded from investment horizon. Are we done here? And then in part 3, in part 3 of the answer you will say possible selection of securities for portfolio construction. Possible selection of securities for portfolio construction. We will say A, C and E. A, C and E. So which means we eliminated B, D and F, and then we are left with A, C and E. And see, there is no logic which will help us eliminate either of these. Risk of 4, 8. Then you increase the risk slightly, you get slightly higher return. Then you increase the risk further, you get return of 12%. Which means we don't necessarily expect that it would be proportionate. If you remember that most of the security portfolio analysis was in the form of a curve graph. So you do not expect that if it's going from 4 to 12, then return should also expect increase 3 times. Isn't it? Because it's a curved relationship, so not necessarily linear. Then let's start solving part B of the question. Assuming a perfect correlation, whether it is preferable to invest 75% in security A and 25% in security C. Now tell me, if it's a perfect correlation, how do you calculate portfolio standard deviation? If it's a perfect correlation, how can we calculate perfect? Perfect correlation means positive 1. So how portfolio standard deviation is calculated?
Standard deviation into weight. Standard deviation into weight of one security brackets of second whole brackets.
Under root.
If it is one, then it will be simply addition. Perfect correlation is one.
See, what was the formula for portfolio standard deviation? Weight 1 standard deviation 1 square plus weight 2 standard deviation 2 square plus 2 into weight 1 standard deviation 1, weight 2 standard deviation 2 into correlation coefficient. Now this is 1, which means it is simply A plus B, and this is 2AB. So which means in bracket we can simply say that this is nothing but weight into standard deviation plus weight into standard deviation square. And if this is the case, that would eliminate each other, the bracket and under root. It would simply become weight into standard deviation plus weight into standard deviation. That means if correlation is 1, then standard deviation of the portfolio is simply weighted average. Are we clear? So write down in the second part of the question, since the correlation between asset A and asset C is 1, the portfolio standard deviation can be calculated. Portfolio standard deviation can be calculated using simple weighted average. And then say standard deviation of portfolio in bracket A and C. Standard deviation of portfolio in bracket A and C is equal to, so in A standard deviation is 4 and we are investing 25%. So 25% into 4 plus, in C, hold on a minute, it's not 25, 75%. 75 is invested in security A and 25% into 12. So what is the standard deviation, weighted average? That standard deviation of the portfolio is now 6%. Then below that say expected return of portfolio. Below that write down expected return of portfolio, again A and C, is equal to, again the logic would be same, 8 into 75% plus 12 into 25% is equal to 9%. So now we are getting expected return of 9 and we are getting standard deviation of 6. Are we okay here? Now we will, how much have we invested in security A? And 25% security C. So we're simply using a weighted average. So once you have this 6 and 9, then we want to compare this with our table. So first we will compare, is there portfolio which has got risk of 6? So we have a portfolio of F which has got risk of 6, isn't it? But the return that it gives is 8, whereas our combination is giving us a return of 9. Then we will check, is there a portfolio which gives a return of 9? So we have a portfolio of 9 which gives a return of 9, which is E, but E gives a risk of 5, whereas our portfolio is giving us a risk of 6, and therefore it makes more sense to invest in E compared to this. So you have to check from both standard deviation and return, and then you would say below that conclusion. In fact, you can make a table like this, it would look better. So you can say here portfolio, in this case you can say A and C, and then you can say F. Then in this column you can say expected return, and in this column you can say standard deviation. Expected return of both the securities is 9%. So here you would say 9% and 9%, but standard deviation of A and C came out to be 6%, whereas standard deviation here is 5%. And then below that write down, since portfolio F has the lower standard deviation, for same expected return of 5%, for same expected return of 9%, portfolio F should be selected over portfolio A, C in bracket. This is E. just make that E. Sentence में भी E कर दो. Are we good to move on? Question number 4. CAPM, risk and return evaluation of security. Exactly the same data, perfect correlation. 80% in U, 20% in W, or 100% Y. So here in this case, they've in fact made it more easier for you because they've also asked you to compare it with Y. So that means you don't have to do that screening. It can be done directly. So do you want to solve this? Try doing it and give me the solution. क्वेश्चन का भी एग्जैक्टली सेम कॉपी पेस्ट करते. इफ यू सी द लॉजिक, पहले वाला क्वेश्चन था November 2002, then March 97, then this is March 2004. They've also kept the logic exactly same, 10, 10 and 10 in the last column. Don't forget to calculate coefficient of variation. Are you done? Have you eliminated security? Which security have you selected? What is the part A answer? Which security should be used for investment horizon? V नहीं आएगा. U, W and Y. सी जो स्टेप 1 था, स्टेप 1 में हम लोग 3 सिक्योरिटी हटाएंगे. इसका रिटर्न 10% है, इसका रिटर्न 10% है, इसका रिटर्न 10% है. U, V और Z का रिटर्न सेम है. But the fact that V and Z have higher return than U, V and Z would be eliminated. Followed? Should I repeat this again? Kulbhushan. See, just a minute. See, Achha. So U and V have same returns. Z has also got same returns, but V and Z has got higher standard deviation. So we eliminate V, we eliminate Z in the step 1. Then we will say that U and X have same standard deviation, but X has got lower return, so we will eliminate X. And then we would be left with 3 securities which are available for investment. So we are left with U, we are left with W, and we are left with Y. U, W and Y. Now once you have U, W and Y left with you, then the second part, you build a portfolio, calculate standard deviation of that portfolio, expected return of that portfolio. So the standard deviation of that portfolio will come out to be 6.6 and expected return of that portfolio will come out to be 11. Aaya ye? Niranjan, you got this? Standard deviation 6.6, expected return 11. It's a simple weighted average. Yes, please let me know. Are you done up to this stage? Do you have a standard deviation and expected return? 5 into 80% plus 13 into 20%. 4 plus 2.6, 6.6. Yes. It is 80% in security U and 20% in security W. Then expected return 10 into 80% plus 15 into 20%. 8 plus 3, 11. यहाँ तक ठीक है? आगे चले? Once you have calculated this, then this is your combination of U and W, and this is Y with whom we have to compare. Expected return here 11, we calculated that to be 11. For Y, expected return is given as 11, so we plot that 11 here. Then standard deviation, we calculated it to be 6.6, whereas standard deviation for Y is 6. And which one will we choose? Y, because it has got lower standard deviation for the same return. So you would say that security Y should be selected over the combination of U and W. Let's move on. Have you understood the problem? And in both the cases, I think the one that we selected in the last scenario was this. पिछले इसमें क्या select किया था? C select किया था हमने नहीं. We selected E in the last case. Okay. Alright, next question. Question number 5. Investment in portfolio and duration November 05. The investment portfolio of a bank is as follows. Government bond 2006, 2010. What are these? GOI 2006, 2010. What is this? तो ये 2032 का इशू क्या है? Maturity. That this will mature in 2006, then mature in 2010, mature in 2032. क्या कह रहे हो? Coupon rate 11.68, 7.55, so on and so forth here. Then purchase rate. Face value is 100, but we purchased at 106. We purchased at a premium or discount? Premium, we more than 100. Then we have duration. And can you see that we have a higher duration for longer maturity? Which is always the case. So you can remember this safely. That longer the maturity, higher is going to be the duration for that bond. Face value of in each government bond is rupees 5 crores. So which means if you've invested 106, it would be 5 into 106 divided by 100, the actual value of investment. Then calculate the actual investment in the portfolio, part A of the question. Number 2, what is the suitable action to churn out investment portfolio in the following scenario? So scenario 1, interest rate are expected to be lower by 25 basis point. And scenario 2, interest rate are expected to increase by 75 basis point. Then it says also calculate revised duration of investment portfolio in each scenario. So let's solve for this. It might look initially a bit difficult, but it's a relatively easier question to approach. Let me first explain you what it means. See, I think a couple of months ago, I attended one conference. This conference was for Franklin Templeton Mutual Fund. Okay, so there was a fund manager. He was basically giving a presentation on a money market fund that they had. A money market fund means that this fund will invest into very liquid security, mostly Government of India bonds. So now, see, yesterday there was a RBI policy review, and what did RBI decide? What to do with repo rates? Repo rates were increased by 0.25%. Now, let's say that you are currently here. Okay, the RBI policy review is going to be here, and you expect that interest rate might increase. Okay, and currently here at this stage you have a portfolio of bonds. Now what you know is that duration is kind of a risk measure of bonds. So let us say that you expect that yield will increase by 1%. If the duration of your bonds portfolio is 5, a 1% increase in yield will, if the duration is 5, 1% increase in the bond will we've done duration. The way we have beta for equity security, the way we have delta for options, in the same fashion we have duration for bonds. So a 1% increase in the yield. Okay, first tell me, will it increase the bond or decrease the bond price? When the yield increases, bond price? ऐसे मत करो यार. When the yield increases, what happens to bond price? नहीं, ऐसे सोचो अभी. Let us say आपके पास एक बॉन्ड है which has got face value of 100 rupees today. Sorry, face value of 1000. Let us say इसका कूपन रेट है 10% और इसका मैच्योरिटी है 3 साल. और आज के रेट में मार्केट में रेट भी 10% ही है. ठीक है. सो हाउ डू यू कैलकुलेट वैल्यू ऑफ बॉन्ड? वैल्यू ऑफ बॉन्ड इज प्रेजेंट वैल्यू ऑफ फ्यूचर कैश फ्लो. सो 100 plus 100 plus 1100. These are my three cash flows. This discounted at the rate of current market yield. Current market yield is 10%. So 10% raised to 1, 10% raised to 2, 10% raised to 3. ये हो गया आपका वैल्यू ऑफ बॉन्ड टुडे, एंड ऑफ कोर्स इफ इट्स 10% इट वुड बी सेम एज 1000 in this case. Now instead of 10% in the market, what if it becomes 11%? So if this becomes 11%, bond price will decrease. And instead of 11, if it becomes 9%, then bond price will increase. So which means that relationship between the yield and the bond price is negative. When the yield increases, bond price decreases. Are we clear with this? Now the question is, it decreases by how much? It decreases by how much? So that approximate relationship is given to you by the number called duration. Have we not discussed duration at all? हाँ अभी तुम तो नहीं बोलोगे अच्छा सो इस साइड में आप रखो बॉन्ड प्राइस and on this x-axis you plot yield. Then the relationship would be somewhat like this, downward sloping. What it means is that when, let's say if this is the current equilibrium, that this is the yield 8% or let's say 10%, this is the bond price 1000. When the yield will increase, bond price will decrease. That's why we have a negative relationship. The slope of this straight line here is called as duration. That a duration of 5 means that if 1% yield is going to increase, bond price will decrease by 5%. Then a duration of 3 means that 1% decrease in the yield would increase the bond price by 3%. A 2% increase in yield will decrease the bond price by 6%. That relationship is of 3. So जैसे equity में beta था, that if market return increased by 1%, your return will increase by 3% if the beta was 3. In the same fashion here we have duration. That if yield in the market decreases by 1% and if you have a duration of 3, then the bond price will increase by 3%. Are we clear here? So let me go back to that question again. So in that mutual fund conference or seminar that we had, all of us kind of agreed on that seminar that in the next policy review there's a good chance that RBI will increase the rate. Okay, so on this date RBI is going to increase the rate, and that time we thought that it would be increased by 25 basis point, but let's assume for our understanding it would be increased by 1%. If you know that yield is going to be increased, then what should you do? If you have a portfolio which has got duration of 5, a duration of 5 means that you've kind of invested on an average of 5-year maturity securities, isn't it? So you should sell those 5-year security and you should probably buy 1-year security. Why? Because in that case your duration will become only 1, or let's say 1.5. The duration will reduce if you sell longer maturity and if you buy shorter maturity. And when yield actually increases by 1%, had you not done anything, your portfolio value would have decreased by 5%. But the fact that you sold longer maturity and you bought shorter maturity, your portfolio value is now going to decrease only by 1.5%. Are we clear? So that's how mutual fund managers adjust in the market. That before the policy review, if they feel that yield will be increased, they sell longer maturity bonds. And if they feel that yield would be decreased, then they buy longer maturity bonds. They adjust the duration of the bond portfolio. So let's solve it part by part. What we will do is, we will have to make 3 tables for this question. In the first table we will solve these two together. Calculate the actual investment in the portfolio. I think this should be sufficient. Fair enough. So let's start solving this. So here we will say government bond. So let me first make the columns here, then you can copy. First column would be government bonds. Second column would be purchase rate. Third column we will say actual investment. Okay. So this is GOI 2006. Then we have 2010, 2015, 2022, 2032. So then purchase rate 106.50, 105.50, in fact 105.00, then same 105, 110, 101. How do you calculate actual investment? Here you will say rupees in crores. You've bought bonds with face value of 5 crores in each of them. So you'll say 5 crores multiplied with 106 divided by 100. So 5.325, and then we get actual investment in each, and total investment turns out to be 26.375. Any question or doubt on this? Next part. What is the suitable action to churn out investment portfolio in the following scenario? Interest rate are expected to be lower by 25 basis points. So give heading number 1. Suitable action when interest rate are expected to be lower by 25 basis point. Okay. So below that you can say once you've given the heading, then you can say, since the interest rate is expected to be lower, since the interest rates are expected to be lower, fund manager can sell the bonds. Fund manager can sell the bonds with lower duration and purchase the bonds with higher duration. Therefore, below that, therefore, fund manager should sell GOI 2006 bonds, GOI Government of India 2006 bonds of 5.325 crores and invest that amount of 5.325 crores and invest that amount in GOI 2032 bonds. In GOI 2032 bonds. The revised portfolio duration can be calculated as follows. Revised portfolio duration can be calculated as follows. Okay, so make this column now. Maturity, amount invested, then here you will say weights, duration, and here you will say weighted average. So portfolio duration again is nothing but a simple weighted average. The way portfolio beta is a weighted average of individual securities. So amount invested here, it is going to be 0 because we have sold the entire amount. Then amount invested here 5.25, 5.25 and 5.5, and the amount invested here would be 5.05 plus 5.325. So you can write down the explanation. 5.05 plus 5.325. Then weights. Are you done writing the explanation? So let me delete, I need this row. So then weights, say 0 divided by this. These are my individual weights. Let me round them off up to 2 decimals. 19.91%. Let's take a total. Total is 100%. 19.91, 19.91, 20.85 and 39.34. Let's plot duration there. 3.5, 6.5, 7.5, 8.75 and 13. Then a weighted average, this number multiplied with weights. So if this is A, if this is B, this should be A multiplied with B. So the answer is 9.73. Is it done? Yes, no. Okay. So second part is now your assignment. What will you do when the interest rate are expected to increase? What should be done if interest rate are expected to increase? Sell high duration and buy lower duration. So I'll just give you what is the answer. That this entire 10.75 which we have here will go here, and this value will become 0. So the answer is going to be 5.99. So if you can solve for 5.99, that would be the correct answer for this question. Have you good? Great, then let's stop. Tomorrow we'll pick up from question number 6.